The life insurance salesman is one of the most dangerous people in your financial life. Not because he's evil, not because he's stupid, but because he's extremely well trained, extremely well incentivized, and sitting across from you at the moment when you are emotionally vulnerable. When you just had a baby, you bought a house, you just lost a parent, and he is about to sell you something that sounds like love and protection and responsibility. And it might be for about 20% of people. For the other 80%, it is one of the most expensive financial mistakes they will make in their lifetime, dressed up in a language of caring for your family. Welcome to the Top Finance. Today we autopsy the life insurance industry. We separate the products that genuinely protect people from the products that genuinely enrich insurance companies, and we give you the framework to never sit across from that salesman confused again. Here's the first thing in life insurance industry does not want you to understand clearly. Life insurance is not one product. It is a category containing two fundamentally different financial instruments that have almost nothing in common except that they both pay out when you die. The first is a term life insurance. You pay a monthly premium. If you die within the terms, typically 10, 20 or 30 years, your beneficiaries receive a lump sum. If you don't die within the term, the policy expires. You get nothing back. The insurance company keeps your premiums. It is simple, it is cheap, and healthy 30-year-old can get $500,000 of 20-year term coverage for $25 to $30 a month. That's it, that's the product. Pure risk protection with zero complexity. The second is permanent life insurance. The whole life, universal life, variable universal life, indexed universal life. These products combine a death benefit with an investment component, a cash value account that grows over time and that you can borrow against while you're alive. They are complicated, they're expensive, often 10 to 15 times more expensive than equivalent term coverage. They are sold with language like forced savings and tax advantage growth and lifetime coverage, and they are responsible for the majority of the life insurance industry's profit margins, because the people who benefit from the permanent life insurance products are the companies that sell them and the agent who earns commissions on them. Let's talk about what happens when an insurance agent sells you a whole life policy versus a term life policy. Term life policy, the agent earns a commission of roughly 30 to 70% of the first year's premium. On a $30 a month policy, that's maybe $18 to $21 one time. Whole life policy, the agent earns a commission of 50 to 100% of the first year's premium. On a policy that costs $300 to $500 a month, that's $1,800 to $6,000 plus ongoing trailing commissions for years afterwards. The incentive differential is not subtle. The agent who sells you whole life earns somewhere between 100 and 30 times more than the agent who sells you term. Now ask yourself, when an insurance agent sits down with you and presents options, when he explains the benefits of whole life with charts and projections and the phrase your family financial security, is he presenting the option that is best for you or the option that is best for his mortgage payment? This is not an accusation against every insurance agent. Some of them are genuinely trying to help, but the structural incentives is not ambiguous, and you deserve to understand before you sign anything. Here's the core pitch of the whole life insurance that sounds compelling until you look at it carefully. Your policy builds cash value over time, a growing account inside your policy that you own, that you can borrow against, that grows tax deferred, that you can eventually surrender for cash if you no longer need coverage. Sounds like an investment account wrapped in a life insurance. Two products in one, efficient, smart. Here's the reality. The cash value growth in a typical whole life policy runs between 1 and 3.5% annually. Meanwhile, the S&P 500 has averaged 10% annually over the last century. The fees embedded in permanent life insurance products, mortality charges, administrative fees, surrender charges, cost of insurance deductions can consume a significant portion of your premium in the early years. Some whole life policies take 10 to 15 years before the cash value exceeds the total premiums you've paid in. And here's the detail that should make you genuinely angry. When you die, in most whole life policies, your beneficiaries receive the death benefit, not the death benefit plus the cash value, just the death benefit. The cash value you spent decades building, the investment component you paid premium prices for, disappears back to the insurance company upon your death. You were paying extra for an account that evaporates the moment it's supposed to matter most. Let's be honest, because nuance is what separates financial education from financial propaganda. There are specific situations where permanent life insurance is a legitimate financial tool. If you have a high net worth estate planning problem, especially if your estate is large enough to trigger federal estate taxes, certain life insurance structures can be used to provide liquidity for estate tax payments without forcing asset sales. This is the real use case for people with estates above the federal exemption threshold, which is currently over 13 million per individual. If you have a dependent with whole lifelong disability, a child or family member who will require financial support indefinitely regardless of your lifespan, permanent coverage that doesn't expire addresses a genuine need for that term cannot. If you are a business owner using life insurance in a buy-sell agreement or key person coverage structure, some permanent products make structural sense in a specific business context. Notice what all of these have in common. They are edge cases, specific, situational, requiring genuine financial planning expertise to evaluate properly. They are not the situation of 32-year-old with 2 kids and mortgage who got talked into $400 a month whole life policy when 35 of term would have protected his family just as effectively. Here's the calculation that the whole life industry spends enormous resources trying to complicate away. Take a 30-year-old buying $500,000 of coverage. Option A, whole life insurance, approximate premium $400 per month. Option B, 20-year term insurance, approximated premium $28 per month. Difference invested monthly in an index fund at 10% average return $372 per month. After 20 years, the term buyer has approximately $270,000 in their investment account. After 30 years, approximately $820,000. The whole life buyer after 30 years has a cash value of approximately $150,000 to $200,000 depending on the policy, and the death benefit their family will receive instead of a cash value, not in additioning to it. The term buyer is self-insured by the year 20. Their investment account has grown large enough that the life insurance itself becomes optional. They have built real wealth. The whole life buyer has built a product their insurance company profits from. Buy term, invest the difference. 4 words that the life insurance industry has spent decades and billions of dollars trying to make sound oversimplified. It's not oversimplified, it's just correct. And here's exactly what you do. If you have a dependents, people whose financial survival depends on your income, you need life insurance. Full stop. This is not an optional. This is not a fear mongering. It's a basic financial responsibility. Get term 10 to 20 times your annual income in coverage. A term length that covers until your youngest dependent is financially independent or until your investment accounts are large enough to replace your income, whichever comes first. Shop it online. Policy Genius, Term for Sale, any aggregator that shows you multiple carries simultaneously. Do not let one agent present one company's products as a market. The market is competitive and the prices prove it. If an agent tries to move you towards whole life, universal life, or any permanent product, ask them one question. Can you show me a side-by-side comparison of this policy versus term plus investing the difference in the index fund for over 30 years? If they can't or won't, stand up and leave. The life insurance industry is not evil. Some of its products are genuinely useful, but it is an industry that profits most when you are confused, that sells most effectively when you are emotional, and that trains its agent to present complexity as a sophistication when simplicity would serve you better. Term life insurance is one of the cheapest and most important financial products most people will ever buy. Everything else they try to sell you in that category deserves a very long, very skeptical look. This is the Tough Finance. We don't die confused. Subscribe because the next video is going to make your insurance agent even more uncomfortable than this one did. And if you are currently paying more than $50 a month for life insurance and you're not wealthy, pull out that policy document tonight. Read what happens to your cash value when you die, then call me back.